Well, a big miss on the jobs front. Only 39,000 jobs created in November. The expectation was for a gain of 150,000 jobs. I want to head over to Bloomberg Surveillance, where PIMCO's Bill Gross is reacting with Tom Keene and Ken Prewitt.
Bill Gross with us, folks, from PIMCO. We welcome all on Bloomberg Television worldwide as well. Bill, to get back to the jobs report and the struggle that's out there, what kind of programs would you like to see out of Washington to get us jump-started towards the 150,000 you talked about before?
Tom, the U.S. is being out-trained, out-educated, out-maneuvered in the global competition for employment, and we need national programs that focus not just on unemployment benefits that we've talked about or low taxes, but which promote 21st century education and not 20th century education. Investors need to think about technological or even manual arts as opposed to liberal arts in terms of universities, and tax policies need to encourage investment and not consumption.
Do we need an investment credit of some form, even if it's skewed to small business? Do we need a jump start here into 2011?
I don't think so. I think we have enough incentives for corporations. When you look at it, corporations have done the best. They've certainly outmaneuvered households in terms of this recovery, and even outmaneuvered governments in terms of their ability to survive and thrive. And so investment tax credits, to my way of thinking, aren't really required. There's enough money for almost any corporation. You mentioned small businesses, but enough money for almost any corporation to utilize if they want to, if they see the eventual demand. And so I think it's just the reverse. We need to focus on the structural problems in the economy and then let the private sector take advantage of that.
I wanted to go back to something you said a few minutes ago. Low interest rates for years?
I think so. Interest rates are a function of several things. Obviously, the Fed and other central banks have mandates. So the Fed has a mandate for financial stability now and for employment and obviously for inflation. To the extent that inflation going forward, and this is probably the key, is a 1% number from the standpoint of the core. That's the probable Fed forecast. And there's no reason for the Fed to raise interest rates, certainly with an unemployment rate at 9.8% or even higher. And so those that suggest that we're going back up to 1 and 2% and renormalizing, I think, are wishful in their thinking.
So if you're a retiree living on your savings, you've gotten basically no return for the past 2 years, and inflation's low, so the Social Security check stays about where it is. And what you're saying, Bill, is that it's likely to continue here.
Yeah, that's the problem, Ken and Tom, that somebody has to pay. It's not always a free lunch in terms of asset appreciation based upon low interest rates. Ultimately, the low interest rate and the negative real interest rate is a serious detriment to savings. And as typical over history, during periods of time like this in which governments are forced to move to extraordinary measures, it's the saver.
Well, that is PIMCO's Bill Gross with Tom Keene and Ken Prewitt on Bloomberg Radio's Surveillance, and he was talking about the structural problems going on right now in the jobs market reflected in this big miss.